All right, so here's the S&P 500. So already have a witch hat bottom here, and then you just ripped. And to dissect this real fast, right? We got long right here. We bull flagged above a downtrend line, which is our number one trade setup. We had our MACD bull cross, and all the stars were aligned. We bull flagged again here. We bull flagged again there. Bull flagged again here. You saw a nice consolidation, price strength confirmation on Monday, Tuesday, Wednesday. Very nice price pattern to stay long. Very nice. I was 140% long market exposure through some of this. Went built some cash in here and in there, and then regrouped. And like I said, I got leveraged long on Friday, and it's paying well. I'm not going to pick a top with my, excuse me, my retirement investment in swing long accounts. My trading account, I'm going to trade that thing like aggressively because that's just what I do. But once again, everybody's different. So we are in a 4-day uptrend. We're getting paid. Reminder, we have event risk on Friday. And then we're going to have earnings season coming up very soon. And that's not the time to be aggressive as we get into earnings season. It's the time to have some runners on and see how things pan out. And then if you do take a trade into earnings, it should be theoretically what we call a free runner, which means you're only risking the house's money. If it's an option terminology, you've scaled enough where you're only risking, the earnings, the gains, not the principal. Okay, let's flip to the NASDAQ. This looks very good. And if you recall, and basically on a lot of these updates, I had a price, what we call a price projected zone. I haven't used that really ever. But it was something like that. And actually, it probably went out over here when I was doing that. And we stay in this zone. And this is a nice zone to be in. And I think if we do fill these gaps up here, you're going to see a nice pause, which would make sense if we get up to 8,000 for us to then pull back going into earnings season. Not going to predict 8,000, but that's really the price projected area that I think we can get up to pretty easily. So stay long versus your stops. I know I say that a lot, but it's very important. Oil, very interesting, breaking the 200-day moving average, and this is taking a long time. Let's look to see how that sector looks. The ETF looks very boring. We'll look at a bunch of stocks. That just looks horrible. I mean, horrible as far as momentum. This has been our least favorite pattern to trade. And by the way, once again, I'm going to redo a lot of the videos under subscribers on the website. Currently, the password, there's no password because WordPress is having an issue with pass protected pages for certain people, whether it's their themes or whatever. Unfortunately, it's me. So, or fortunately, there's no password right now. It is what it is. All those videos are old anyway, and they need to be redone. So currently, there's no passcode on them. I might keep it that way until I start rebuilding it, to be honest with you. So anyway, with that said, the reason why I brought it up is there's a pattern under there called the wedge. If you don't know about it, you should read up on it. I think there's some diagrams and maybe even a video. And when you get in this wedge, it's very tricky. It bobs back and forth to the top and the megaphone, bottom of the megaphone. And it's just not a pattern I prefer to trade, so I'm staying away from it. IYT, this is very nice. So you have a head, left shoulder, right shoulder. And now this is the sector you really would like to see. With the banks sleeping, oil sleeping, you need something besides, just the SPX. IWM's sleeping too. So let's hope that these transports start carrying us. A nice megaphone or a wedge pattern in the IBB. Yeah, that's not a great pattern to trade. UDOW, I like this a lot. I'm long UDOW. I think we could possibly get to 110. I'm staying long versus my stops. And by the way, my stops are Friday's low. Just brings up another great point. Someone had said, they get emotional with their trades when they start turning red. And this is so important. I say this all the time. You have to define your risk before every trade, and that's what the ESFL is for. If you're a swing trader, you're defining your risk versus the stops, whether it's the options or the stock from the ESFL. If you're a hybrid trader, you're using the previous day's low for longs and previous day's high for short. So you don't have to short the market. Remember that. It's almost like a myth on Wall Street. You have to be able to short stocks. You don't. I've been there before. I have 20 years trading experience. I know for a fact you don't. So if you're struggling trading, that's one thing to eliminate. Don't trade the uptrend. Don't trade the downtrends and no trends. There's plenty enough time to be long the market and make a killing in the market, even in bear markets on the long side. So if you're struggling, let me just tell you, shorting is for the professionals. I do classify myself as a professional, but I still also don't think it's easy. So with that said, let's see. I think I went over everything with the indexes. Gold continues to not look good. Bonds are pulling back here. They did break new highs. They did not hit new highs with MACD, so they're coming back in. They're probably going to touch the 50 SMA. To me, long term, over the next 6 to 12 months, I still favor bonds. Not necessarily over stocks, but I'm bullish both.